I'm Eric,
And I'm Dave.
and we're here to describe a myth that seems to persist even to today, and including into today's non home buyers yet, that there is some sort of big down payment required to close on your first home, invest in your first property that you're going to live in. Dave, I think that's something that you see, I see, and we need to have more information and dispel some myths in this respect.
Yeah, absolutely, Eric. And I think a lot of that resonates from what people have heard historically from their parents, their grandparents, that, because at one point in time, you were required to have a pretty large down payment. But there's so many things in place now as far as low down payment loans. Most loans on a conventional loan, for example, only requires a 3% down payment. And, an FHA loan is 3.5%. But there's programs like USDA and VA and some other down payment assistance programs that can actually get you into a home with 0% down.
Absolutely. And on the real minimal down payment, so maybe the zero down, you are going to have some stipulations. Like for a Veterans Administration loan, you have to qualify by being in active duty or having served and earned the eligibility to perform VA financing. So there's a few things that relate to geographically or the parameters like USDA of how you qualify or maybe don't qualify if you hit certain thresholds. But outside of that, this whole concept of a 20% down payment required for someone to buy their first home that they're going to live in is frankly something that hasn't existed in both your career or mine.
Yeah, and there's things like we touched on in our acronym video that we did. We talked on mortgage insurance, and so that was something that came about to help people on a conventional loan, well, and FHA for MIP, to not actually have to have that 20% down. So they would have mortgage insurance in lieu of having to have a 20% down payment. That actually, as we discussed before, actually protects the lender in the event that the borrower goes into foreclosure, but it does give the borrower the benefit to not have to have and save that whole 20% down payment. And they can get in a house much sooner than you could when a 20% down payment was required.
So another way that your description right there kind of reminded me of is that you're buying a home, and if you have a loan, the lender is buying the home with you. So if you're putting down, let's just say 20%, then the lender is investing 80% of the funds to buy the home with you. You're just at the top part of it, the riskier part, and the lender then is at the rest of it. And so when you just mentioned mortgage insurance, that allows actually to exceed the 80% of the investment by the investor, the mortgage-backed security holder, the lender, you might call it. And so if you went to 97 or 96 and a half or 95, that means that the lender is fronting all that money and there's going to be a little insurance coverage to help accomplish that goal.
Yeah, and I think something that a lot of potential homeowners don't think about too is they may have the 20% or greater down payment, but maybe it doesn't make sense to put down the whole 20% or 30% and save that some of that money to buy another investment property or to do something else with that money versus putting the entire down payment down and use that to leverage some other investment opportunity.
So something that I used to really delve into with some of my first time buyers who literally were buying their first house, and in a lot of cases it might have been an FHA loan. It might have been with funds that came from household, not household, but family members that were able to gift the down payment or gift the amount of money it took to close. And talking about a rainy day fund. So you maybe don't want to, if you have literally 10% down, 20% down, 5% down, you may not want to use all of it because you want to have a little cushion for expenses that do come up, new tires on the car, buying a lawnmower, these things that are real life. And you also may have other debts that are sitting there that might be a squeeze on your ability to buy a new home. Maybe you could use some of the money you have saved up and pay those down or off and come into the home ownership with a little less or a little bit more breathing room, a little less, tight budget to afford the house. Maybe you could talk about that a little bit.
Yeah, that's a great point, Eric, because there's so many people that come into home ownership knowing exactly what they can afford as far as their mortgage payment itself goes compared to maybe what they're paying in rent right now. But a lot of times it makes more sense to put down less of a down payment and use some of the funds that you have saved to pay off things like a car or a high interest credit card. That what's going to happen is you're going to get into that new home that might have a little higher monthly payment than what you're paying in mortgage right now. But if you look at your overall debt service that you're paying on a monthly basis, using some of that money to pay off those other expenses, again, like high credit cards, maybe an auto loan that has a few months remaining on it or something like that, they can actually lower your overall monthly payments considerably if you use some of that money for paying off that other debt instead of as your down payment.
Absolutely. And this is not a debt to income qualifying conversation we're having here. It's about the down payment, but a lot of that is tied together from the standpoint of if you borrow more, then you're going to have a larger payment on the home, but you may have fewer obligations after the fact, after you close, and vice versa. So it's kind of very custom to what your individual motivations are as a homeowner, as maybe someone who's had advice thrown at them from different relatives, friends, people that they know that may have an impact on your judgment of how to go about buying a home. We would like to dispel a lot of that and clean that up early in the process. And that's part of the pre-approval process we work towards with our applicants and borrowers.
Yeah, and speaking of advice, not that we're giving any kind of tax advice at all, but if you were to put down less on the home, you would have a higher mortgage payment and therefore you'd be paying higher interest. However, there is no deductibility for interest on your credit cards or your auto loans or some of those other consumer debts like there is in for mortgage interest, which is one of the few remaining tax benefits that we have.
Well, and this is not about appreciation of a home here either that we're talking about, but there are some aspects there to where a lot of people get confused that, well, if I put more down, I'll have more equity. You'll start out with more equity, but the house and its appreciation that it will experience over time, and basically that goes back to recorded history, the last 100 years in homeownership, is that essentially every year you're going to see in a 5 year window, you're going to see homes appreciate. And when that happens, it's on the value of the house, not the mortgage balance.
Absolutely. And speaking of mortgage balance, the other thing you benefit from with home ownership and getting a mortgage is amortization. So you're going to owe less on the home over, let's say, a 5 to 10 year period. So making your regular mortgage payments on a 30-year mortgage, you're going to pay down your principal balance, which means you're going to owe less. So you combine that amortization or that decrease on your loan balance with the appreciation, and there's a pretty nice net gain there as a homeowner.
And there's also things to factor in, such as if you're looking at borrowing the max on a house, are you a young person who has a long runway for employment, for income generation over time, and probably some acceleration of that income generation? Or are you nearing retirement and want to consider things a little differently? So, of course, we would like to customize and talk through all of those aspects to any individual borrowing situation to match it up with both your motivation, your needs, but also your capabilities and where you want to go and see things in the future.
That's a great point, Eric. Just, having that consultation with a mortgage advisor that's a professional that understands your entire interest and what your objectives are, in the future, both short and long term, to make sure that you're in the right program and just thinking about all your needs.
Absolutely. So there's a lot to go around down payment. There's also different programs, as you mentioned, as you introduced Dave at the beginning of this podcast, that reflect different down payments, different qualifying criteria. So you can't come into the transaction thinking, I want this, because there may be more opportunities to both take advantage and or qualify you for a bigger house than what you initially thought you were interested in. There's a lot to work with there.
Yeah, definitely a lot of options, because you'll hear somebody say, "Oh, well, you have to do this or you have to do that," which may be the right scenario for them, but it may not be right for you. So that's why it's, again, a great idea to have a real a consultative approach with your mortgage advisor.
Absolutely. So we hope we cleared up a little bit about the down payment myth of 20%. There's a lot more to obviously talk about it, but those may relate to your specifics. And we highly encourage you to reach out to a mortgage professional. Obviously, we are mortgage professionals, and have someone help guide you through what your options might look like.
Awesome, Eric. Thank you.
Thank you.